Welcome to The Explainer. Okay, let's get right into it. The US dollar, the backbone of the entire global financial system, well, it's starting to look a little shaky. Today, we're going to dig into why it's falling and what the Federal Reserve might have to do about it.
So, here's the headline that's got everyone on edge, from Wall Street to Tokyo. The US dollar, which has been the bedrock of, well, everything for decades, is seriously stumbling.
And look, this isn't just some small blip on the radar. We're talking about the dollar hitting a 4-year low. That's a huge deal, and it's definitely got investors and policymakers pretty worried.
Okay, so when we say the dollar is falling, what do we actually mean? Well, we're talking about this thing called the DXY, or the dollar index. The easiest way to think about it is like a report card for the dollar. It grades its strength against a whole basket of other big currencies, the euro, the yen, and so on. So when that DXY number goes down, it means your dollar just doesn't buy as much as it used to on the world stage.
Right, so you might be asking, why is this happening now? Well, it's not a fluke. This is really a perfect storm of things happening all at once. We've got some pretty concerning signals coming from inside the US economy, and at the same time, a ton of pressure from events happening all over the world.
All right, first up, let's take a look under the hood at America's own economy, because things are getting, they're getting a little messy.
First things first, inflation. It's hanging out at 2.7%, which you'll notice is still stubbornly above the Fed's 2% target. What that means is the Fed can't pop the champagne just yet. The fight against inflation, it's definitely not over.
Then you've got the job market. Oof, only 50,000 new jobs were added in December. Now, a cooling job market can actually help bring down inflation, but a slowdown this dramatic, it's starting to make people whisper about the real strength of the economy.
And this number right here, this really tells you how people on the street are feeling. Consumer confidence has absolutely cratered, down to 84.5. That's the lowest it's been since 2014. It's a flashing red light that regular Americans are feeling really anxious about their money and their future.
And if that wasn't enough, we've also got manufacturing slowing down. And to top it all off, some of the most important economic reports are being delayed. So you've got the Fed and investors basically flying blind here, trying to make huge decisions without all the data they need.
So, the U.S. economy is looking pretty shaky. But this story isn't just happening inside America's borders. The plot gets way thicker when you start looking at what's going on around the world, because a whole bunch of conflicts are throwing a wrench in the works.
So let's pull back for a second. We're going to zoom out and really connect the dots here. How exactly do these rising tensions overseas end up hitting the Fed's decision-making process right here at home? And this is a perfect example of that chain reaction. Let's take a crisis in Iran. Tensions flare up, and suddenly everyone's afraid of a bigger conflict. What happens next? Global oil prices spike. And when oil gets more expensive, so does everything else. That's inflation. That puts the Fed in a really tough spot, maybe forcing them to delay interest rate cuts, which means borrowing money stays expensive for all of us.
And hey, it's not just about Iran. It feels like we're living in a world full of these interconnected worries. A conflict over in the Taiwan Strait that could totally wreck the supply chain for computer chips, and suddenly everything from your phone to your car gets more expensive. The war in Ukraine is still a huge risk for Europe's energy supply. Every single one of these hotspots adds another layer of what if that the Fed just can't ignore.
Which, of course, brings us to the billion-dollar question. You've got a wobbly economy at home and a world that feels like it's on a knife's edge. So what's the Fed going to do? What's their next move?
All right, so when we look at the analysis, our sources are basically laying out 4 possible scenarios for the Fed over the next 3 to 9 months. And each one gets triggered by a different mix of what's happening with the economy or what's going on in the world. This table does a great job of breaking it all down. Let's walk through it. Scenario 1, the base case, is the most likely. This is where the economy kind of cools down gently and the Fed can just hold rates steady. But look at the other options, because this is where it gets interesting. A hawkish turn. That means they get tough on inflation, could be triggered by something like an oil shock. That would force them to delay any rate cuts. Then you have the dovish side. If consumers suddenly stop spending, the Fed might have to jump back in and start cutting rates again to boost the economy.
Okay, so we've got these 4 different roads the Fed could go down. Which one is the most likely? Let's take a look at the actual odds.
You can see it right here. The base case, just holding things steady, is a coin flip, about a 50% chance. But here's the kicker. Look at that 30% slice for a hawkish turn. That's a pretty big chance. It means a global shock, say oil prices going through the roof, could easily force the Fed to slam the brakes and keep rates high to fight inflation.
So what our sources are saying is that, yeah, holding steady is the most likely play. But the Fed is basically walking a tightrope right now. Any big event that's totally out of their control could easily push them off in one direction or the other.
When you boil it all down, the Fed is really stuck between a rock and a hard place. They've got two bad options, and both have huge consequences. Do they keep rates high to crush inflation for good, even if that means tipping the economy into a recession? Or do they cut rates to give the economy a boost, but risk having inflation come roaring back?
And that leaves us with the one question that's going to define the economy for the rest of the year. You've got inflation on one side, recession on the other. Which fire will the Fed be forced to put out first? Whatever they decide, you can be sure it's going to affect all of our wallets.